Investment flash.
Iran strikes, oil spikes, and the dollar rips to a 52-week high. But forget all that, because Chinese AI is quietly reordering the world, and Alibaba just surged 14.7% in a week. I'm Tom, and this is Investment Flash.
It's Monday, July 13th, the New York edition. I'm Marie with Gerald and Tom. And Tom, I see you're already off to the races on Chinese AI.
He's been like this since the London Open, mate. One Goldman note, and he's already renaming the podcast Alibaba Flash.
Gerald, 3 separate sources today, buddy. Goldman, FT, Nikkei, DoorDash, Siemens, Airbnb. They're all adopting Chinese models. This isn't a trade, it's a structural demand shift.
Right, and that's the thing. The FT piece is our most original take today. Western companies undermining U.S. tech dominance by turning to Chinese AI to cut costs. That's a durable, non-cyclical driver.
To be fair, Alibaba is up 14.7% in the last week. That's not exactly a secret. The trade is crowded, Tom.
Crowded? Alibaba is still down 28% year to date. There's plenty of room. And Baidu, flat on the week, down 22% year to date. The AI narrative hasn't been fully priced for the rest of the sector either.
And the China Internet ETF, KWEB, barely moved in Friday's session, still down 26% year to date. So even with the weekly surge, it's nowhere near overbought.
Right, because buying Chinese ADRs has never blown up in anyone's face.
Oh, come on, Gerald. Look at Nikkei. Indian companies are now adopting DeepSeek, Alibaba, Moonshot. This is global. The China AI story has legs.
And it's not just the stock picks. The convergence here is powerful. 3 publishers, 2 different angles. Goldman with the stock picks, FT with corporate adoption, Nikkei with India. That's a real signal.
Look, I'm not saying there isn't a story, but last week's episode you were all over BYD, Tom. How's that working out?
Fair enough. But BYD's up 3% in Friday's session, thank you very much. And Genesis Minerals for Marie, nice call.
It was a structural play. Speaking of which, battery and minerals, FT has Australians going gangbusters on Chinese batteries for renewable storage. And Bloomberg says Beijing is backing a new mining investment firm for strategic minerals. Lithium and rare earths both pulled back significantly last week.
Right. The lithium and battery ETF LIT down 5%. Rare earths ETF REMX down 6.5%. That's a gift. The demand is structural. Australian batteries, Chinese government buying. This is a no-brainer for a pullback entry.
A no-brainer until China bans rare earth exports and spikes the price, which, by the way, nobody seems to be discussing. That could move REMX 20% overnight. Worth a watch.
I'm going to push back here, Gerald. The point is the asymmetry. LIT and REMX are deeply oversold on technicals, but the fundamental demand from both Australia and China's own strategic push is accelerating. That's a setup.
Exactly, 100%.
All right. You two have me cornered on green metals. But let's talk about what's actually moving markets right now. Iran.
Friday's session was all risk-off. Oil surged, the dollar blew to a 52-week high, and long bonds got hammered. Gold and silver sold off hard because the strikes fueled rate hike expectations.
And this is the key. The dollar is strong because it's a safe haven, but bonds are weak because of inflation fears. It's the twin inflation trade. The dollar ETF UUP at a 52-week high. The long-duration Treasury ETF TLT just 2% above its 52-week low. Extreme positions.
Okay, Gerald, but aren't those trades super crowded? TLT at the low, UUP at the high. If there's any de-escalation or a dovish Fed hint, that pair violent unwinds.
That's the risk, yes. But the macro backdrop right now supports it. Oil is the transmission mechanism. Higher oil means higher inflation expectations, which means rates stay higher, which kills bonds and gold and boosts the dollar. It's a coherent regime.
Right. And that's why precious metals got wrecked. The gold ETF GLD down 1.3% last week, silver ETF SLV down 3.8%. When real yields rise, gold doesn't act as a safe haven. It just sells off. The old playbook is broken.
So we're selling gold and silver. That feels icky, Marie, but the logic is sound.
It's not about feeling icky. The macro forces are clear. GLD is 26% below its 52-week high, so there's room. SLV is a disaster, down 18% year to date. The bear case isn't crowded.
Finally, Marie agrees with me on something. Mark the calendar.
Don't get used to it.
All right, but let's talk about the tech route. FTT says investors are cutting bets on TSMC, SK Hynix, Samsung. Those three alone were 29% of the EM index. TSMC down 3.9% last week. The rotation is real.
And the semiconductor ETF, SMH, is still only 9% below its 52-week high. That's not a rout, Tom. That's a gentle breeze.
Momentum is turning, Gerald. When the most crowded trade starts to unwind, it can go further. South Korea, EWI, down 3.3% last week. It's a direct proxy. Sell TSMC, sell SMH, sell EWI.
Wait a second. Are we sure this isn't just geopolitics? A temporary Iran scare sparks profit-taking in over-owned names. If tensions ease, these stocks snap back hard. The long-term AI chip demand thesis hasn't changed.
Marie, you're always the contrarian. But this time, the positioning is so extreme that a mean reversion is probably healthy. And we've seen this before. Chip rallies don't go vertical forever.
He's not wrong. When a sector becomes 29% of the EM index, it's begging for a pullback. It's basic PE gravity.
All right, but I'll be watching for a reversal headline.
Fair. Now, food commodities. Bloomberg's John Authers flags a double supply shock. El Nino and the Iran war squeezing food. The AG ETF DBA up only 0.8% last week. The market hasn't priced this.
Right, so this is actually an early trade, Tom. Wheat, WEAT, was up 2.9% in Friday's session and 18% year-to-date. But the real spike could come if the conflict escalates. Agricultural commodities are asymmetric.
And the consumer angle, U.S. consumers are already on edge about high food prices. Any further spike hits sentiment directly. That feeds back into the macro picture.
So we're long wheat and long the AG ETF. Simple. I like it.
Of course you do. It's a momentum trade, buddy.
Quickly, two other stories. Citigroup. Jane Fraser's restructuring, asset sales, job cuts, closer Trump ties. The stock is up 18% year-to-date. Much of the turnaround is priced in, so we're holding, not buying more.
To be fair, restructuring stories rarely deliver quick upside. The market's already given her credit. The financials ETF, XLF, isn't moving on this. It's a firm-specific story.
And the HSBC board lot reform in Hong Kong, SCMP says it'll boost turnover and retail participation. Low-risk catalyst. Buy HSBC, buy HKEX.
It's incremental, but it's exactly the kind of structural catalyst that works over time. No drama, just a steady grind.
All right. Shall we get to the synthesis? Because I know Tom has a paired trade brewing.
I do. Our view today, fade the consensus. Long Chinese tech proxies, like the China Internet ETF KWEB, versus short U.S. duration, like the long duration Treasury ETF TLT. That pairs a structural tailwind against a crowded macro short.
Hang on. That's actually clever. You're getting the Chinese AI adoption story, which most macro models miss, while shorting the most consensus trade in the bond market. If anything changes, one side cushions the other.
Exactly. And the China side has the convergence. Goldman, FT, Nikkei, while the bond side is just riding the extreme positioning. It's not a bet on Iran or the Fed. It's a bet on the divergence between old risk-off and new structural growth.
And if the tech name sell-off continues, KWEB is still insulated because it's not a chip proxy. It's internet and AI platforms. It's a cleaner expression.
One risk, If the Fed suddenly turns dovish, TLT rips higher and crushes the short, so size it, but the logic holds.
As always, none of this is investment advice, just our take on the signals. And Tom, if you're just finding us, hit follow on Spotify or check investmentflash.com for the full digest with charts and sources.
Marie with the plug. Smooth.
We're back tomorrow with the London edition at 7:30 a.m. London time. See you then.